Many people believe that once the clock strikes midnight on December 31st, your tax fate for the previous year is sealed. That is a myth. And for high net worth individuals, it's a very expensive myth. The IRS grants you several powerful opportunities that you can use in 2026 to directly and legally lower your 2025 taxable income. In this video, we're breaking down the three major categories of actions that you can take right now during tax season to shrink that 2025 tax bill. Our first category has a non-negotiable deadline, April 15th, 2026. This is the standard due date for your individual return, and even if you file an extension, you must fund these by this date to claim the deduction for 2025. Traditional IRA contributions. You can fund a traditional IRA up to the 2025 limit, which was $7,000, plus an extra $1,000 catch-up if you were 50 or older in 2025. The catch, the ability to deduct this contribution is phased out at higher income levels if you or your spouse were covered by a workplace retirement plan in 2025, like a 401k. For a single filer covered by a workplace plan, the deduction is eliminated once your modified adjusted gross income, or MAGI, reaches $89,000. For a married couple filing jointly, where both are covered by a 401k or the like, a 403b, the deduction is eliminated at $146,000 of MAGI. And if only one spouse is covered, the deduction is eliminated once your joint MAGI reaches $246,000. If you fall below these thresholds, this is a dollar-for-dollar reduction of your 2025 adjusted gross income. Number two, health savings accounts, HSAs for short. If you had a high deductible health plan in 2025, you can still maximize your HSA contribution. For 2025, that was up to $4,300 for a self-only plan, or $8,550 for a family, plus a $1,000 catch-up for those 55 and older. This is a triple tax advantage deduction. It reduces your 2025 AGI, grows tax-free, and is withdrawn tax-free if used for qualified medical expenses. Miss the April 15th deadline and your 2025 opportunity is gone forever. So act fast on these two. Moving on. This is where tax planning gets truly strategic, particularly for self-employed individuals and business owners. If you file a timely extension, the deadline to fund your employer-based retirement plans for 2025 is pushed all the way out to October 15th, 2026. SEP IRA contributions. This is the simplest option. If you're a sole proprietor or have a side gig, you can set up a brand new SEP IRA plan and fund the entire 2025 contribution all the way until October 15th. The 2025 limit is the lesser of 25% of your compensation, or $70,000. Maxing this out can instantly reduce your 2025 taxable income by tens of thousands of dollars. A solo 401k employer profit sharing plan. If your solo 401k plan was established by December 31st, 2025, you can still fund the generous employer profit sharing portion, which is up to 25% of compensation. You can do this by the extended October deadline. When you combine the employee deferral with the employer contribution, this is often the largest single deduction available to a high earner. Moving on to number 5, a defined benefit plan. For the highest earners, especially those over age 50, a contribution to a defined benefit plan or cash balance plan can allow for contributions that exceed the limits of a 401k by a lot, often reaching over $250,000 for the 2025 year. Like the solo 401k, the plan must have been formally adopted by December 31st, 2025. But The massive funding contribution can be made all the way until October 15th, 2026. These business retirement plans are the ultimate form of retroactive tax planning, but you must file that extension. Our third category involves decisions you make on the actual filing of your 2025 tax return in 2026. These are technical elections that can instantly create massive paper losses. Let's get into the first one. Section 179 and 100% bonus depreciation. For any qualifying assets you purchased and placed in service after January 19, 2025, you have a final opportunity on the 2025 return to elect 100% bonus depreciation. The One Big Beautiful Bill Act permanently restored the 100% rate for assets placed in service after January 19, 2025. This allows you to deduct the full cost of new equipment, machinery, and qualified improvement property in 2025, regardless of when you pay for it. Moving on, cost segregation study. If you acquired a commercial or residential rental property in 2025, you can commission a cost segregation study in 2026 and use that on your 2025 tax return. This study legally reclassifies portions of the building from a long life down to shorter lives, making them eligible for 100% bonus depreciation. This often unlocks a six-figure non-cash deduction on your 2025 return, potentially creating a significant paper loss. Number 8, research and development. Expensing election. Another major provision of the One Big Beautiful Bill allows businesses to elect to immediately expense domestic research and experimentation costs for the 2025 tax year, reversing the controversial requirement to capitalize and amortize these costs. So, if your business had research and development activity in 2025, making this election on your 2025 return in 2026 will lead to a dramatic immediate reduction in taxable income. For high net worth taxpayers, tax season is not just about filing, it's about making final high impact decisions. Whether it's the strict April 15th deadline for your HSA, the extended deadline for your SEP IRA, or the powerful accounting elections like cost segregation and R&D expensing, these 2026 actions are the final levers you have to control your 2025 tax outcome. If your tax situation involves business income, real estate, or complex investments, you need a plan that goes beyond simply gathering your 1099s. You need to create a tax plan. Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.